So if you filled up your vehicle recently, you may have had a pleasant surprise, a decline in the price of gas. Does this mean high inflation is over? Probably not, but it may be an indicator that things are not quite as dire as some would have you think. And when a news article refers to what economists think, is that a prediction that we can rely on? First, let's talk about gas prices. Anyone who drives a car knows prices have been high for much of the summer, but they have recently been falling along with oil prices. Over the past month, the national average price per gallon has fallen from $5.02 a gallon to $4.47 a gallon. That's almost an 11% drop in 1 month. As the price of any good rises, demand for it tends to soften over time, and this appears to be the case recently with oil and energy. Look at the year-to-date path of both gas and oil prices. There was a sharp spike, obviously, in February, March when Russia invaded Ukraine, and there was questions about the gas supply that was coming out of Russia. Then another spike in prices early summer as the demand and travel really took over. But recently, we've seen those things decline, probably because demand has started to soften, and there's been some good news on the supply side from OPEC. Converting these numbers to percentages, you can see the very high year-to-date inflation numbers. It's easy to see how this could have impacted that 9.1% CPI number. It's also easy to see how a decline in these numbers, the stabilizing of energy prices, could contribute to a much lower future CPI. Gas prices, oil prices, and other readings have indicated that the overall economy may be slowing a bit. Higher mortgage rates have contributed to fewer home sales, and the general consumer sentiment indicators remain somewhat negative, implying slowing spending. However, some slowing may actually be a net positive because it ratchets down inflationary pressures in the economy, and it may help the Fed to not have to overcorrect or raise rates too high too fast, which possibly could contribute to an unnecessarily deep or prolonged recession, if we have one at all. This has not been missed by the market. The 5-year TIPS Treasury break-even rate, which is a reasonable proxy for what the bond investor thinks inflation will be over the next 5 years, has fallen from a high of close to 3.6% to 2.67% on Friday. This break-even rate is what inflation would need to be to give the nominal Treasury investor and the Treasury inflation-protected security investor the same realized return. An even more dramatic reduction in expectations can be seen in the 1-year break-even rate. In March, 12-month inflation expectations ran as high as 6.3%, but now they've fallen closer to 4%. They seem to be on the way down. Overall, bond investors are showing less concern about long-term inflation since inflation expectations appear to have peaked sometime in March of 2022. Investment markets have been responding positively over the past month to the various financial and economic items that we've just talked about. Even with Friday's lower closing on the U.S., the week in the previous 30 days have seen some recovery. I've included the 10-year Treasury rate change in this chart to help explain why bonds have been going up so strongly. Remember that bond prices are inversely related to bond rates. So bond prices rise when market rates fall. The combination of moderating rates in the market plus now higher coupons available to investors has really been a good combination for bond investors. When you hear economists see or economists are forecasting, it can sound like there's a consensus or a broad agreement on some data point of prediction, whether it be about inflation rates, recession chances, unemployment, or oil prices. But what's really going on when you see a survey of economists? The June 2022 survey done by the Wall Street Journal, it includes 52 separate economists who are asked to make predictions about specific data points. One of them is the probability of the U.S. economy being in a recession 12 months from now. If you look at the survey, it would say the average response is there's about a 42% chance that the U.S. economy will be in recession 12 months from now. But if you look under the surface at the responses of each of the 52 economists surveyed, what you find is a range of people who think there's just a 1% chance of the economy being in recession 12 months from now, and someone who thinks there's a 99% chance that the economy will be in recession 12 months from now. So when you see economists say or economists predict, it's not representing some kind of consensus where they've all come to agreement. It just represents the average of a widely divergent set of opinions about what they think economic numbers might look like 12 months from now. Behind the average is just a wide range of opinions and educated guesses. A couple may actually get it right, by skill or by luck. But the question an investor has to ask is, do you want to base long-term investment decisions on this wide range of predictions that may or may not actually be accurate? The question really is, can we recognize an accurate forecast in advance? Recently, there's been some good examples of experts who have admitted, hey, we got it wrong. Fed Chairman Powell said in congressional testimony, the Fed just got it wrong. They misjudged inflation's momentum in late 2021. Nobel Prize winning economist and New York Times columnist Paul Krugman said that he was wrong about inflation, which I appreciate his intellectual honesty in writing about how he did get it wrong. And then we've seen other predictions come out that also look like, well, now that kind of the prediction of a $6.20 price per gallon for gas in August is probably not going to come true. People were doing the best they had with the information they had at the time, but it just underlines the idea or underscores the idea that predictions are very hard to make successfully. So for us, being a successful investor means I'm not going to rely on these short-term predictions to make long-term investment decisions. We still think being diversified, staying invested, and embracing or accepting uncertainty are key behaviors to successful investing. That seems to be more true than ever based on the way things are going in the economy. I think more surprises are ahead. But for people who have a long-term view, we think the market continues to offer great opportunities for portfolio investors. As always, thanks for watching, and we'll see you in a couple weeks.